The Dutch East India Company operated a vast fleet of ships to trade valuable goods like gold, porcelain, spices, and silk across the globe. But managing such a large-scale operation was expensive. To cover the costs of their voyages, the company invited private citizens to invest money in exchange for a share of the profits from each expedition. This strategy allowed the company to fund even more ambitious trips, which boosted returns for both the company and its investors. They sold these investment shares in coffee houses and port cities throughout Europe, accidentally creating the world's first stock market in the process. Since then, companies have continued raising money from investors to support their ventures. Today, the stock market has grown into a complex system with entire schools, careers, and TV networks dedicated to analyzing it. So how does the modern stock market actually work? Let's take the example of a new coffee company preparing to go public. First, it pitches its business idea to major investors. If those investors see potential, they provide early funding and help launch the company's initial public offering, or IPO. The IPO marks the company's debut on the public market, where anyone, individuals or businesses, can buy shares if they believe in the company's future. Purchasing a share means owning a small part of the company. Investors' money helps the company grow, and as it performs well, more people want to invest. This rising demand pushes the stock's price up, increasing the value of shares for current owners. The company also benefits, as high demand and rising stock prices signal confidence in its potential and boost its market value. But if the company starts to seem less promising, whether it's because of poor performance, some negative news, or even shifts in the economy, investors might decide to sell their shares to avoid losing money. And, as more people sell, the stock price begins to drop, pulling down the company's market value with it. Stock prices, they're constantly moving, right? And that's because of supply and demand, which are influenced by a whole mix of things. It could be something like the cost of raw materials, new technologies coming into play, labor expenses, or even broader issues like laws or trade policies. Oh, and let's not forget, investor concerns about leadership changes, scandals, or even their own personal financial goals can really add to these market fluctuations. Those daily ups and downs you see, often called market noise, can honestly distort how successful a company really seems. And here's the thing, when a company appears to be losing value, it often does, simply because investor confidence starts to drop. In fact, public perception can trigger anything from market booms to major crashes. Because of this unpredictability, financial experts typically recommend long-term investing strategies over trying to make quick profits. That said, analysts continue developing tools and models to better understand and navigate this volatile system. And thanks to the internet, stock investing is no longer limited to the wealthy. Everyday people can now trade stocks much like large firms do. With the right education and awareness, anyone can invest in businesses they believe in and work toward their financial goals. The most important step: getting started.